This is some of our and my social media, so you can connect on any of these links, and don't be shy. I think everybody can get a copy of the slides after the workshop, so don't worry too much about taking notes. This is a brief history of Expara, which I already pretty much talked about, and some of our metrics over our 24 years of experience in the business, and look at our regional strategy. Our most successful investment, which I like to highlight in our I highlight in class and a workshop, because I think one of the points that I like to make, or one of the things I like to communicate during my sessions, yeah, like one thing is different about my experience in venture capital from most people is doing what I would call traditional venture capital investment, but in Southeast Asia. I think a lot of the experience that people have in venture capital and high growth startup is in the US or China, or some of the much bigger venture capital markets. And I think there's often some like skepticism or feeling like, yeah, you can create successful, scalable startups in other markets, but not in Southeast Asia. Actually, I was recently talking to a business journalist in Thailand who wanted to have a discussion with me about how come there's no Thai unicorn startups? After all these years, no Thai unicorn startups. I I felt like I discussed with him, and I felt like actually this is the wrong question. It's it's something that, it's not wrong to ask that question, but it's not really meaningful question, because why? First of all, unicorn is pretty much, first of all, unicorn is a pretty vaguely defined term, right? I mean, what is a unicorn startup? Like, I think if you do a search on unicorn startups, Google or in ChatGPT, you're going to get a lot of companies that are currently valued as unicorns, meaning they have raised some money during the course of their fundraising history. They've raised some money at a valuation above US 1 billion. Now, this is the first thing I think that's wrong with the whole unicorn concept is, why 1 billion? Why is a 1 billion valuation magic? Like, what's the difference between a 900 million valuation and a 1 billion valuation? Or why is it somehow company reaches 1 billion and now they're successful or super successful? I think the number 1 billion, it's not meaningful at all. What's really important, so that's issue one, is companies, the 1 billion benchmark doesn't actually mean anything. And then next thing that's wrong with this definition of unicorn is fundraising valuations also don't mean anything. The valuation at which the company is raising current round or next round funding, they're not important benchmarks for the development of the company, or necessarily for the value of this investment for shareholders. Because for venture funded startups, the fundraising valuations are the real benchmarks of valuation. I mean, they're accurate valuations as far as any valuation of any company goes, but with the caveat that they're valuations in extremely illiquid investments. So it's very difficult to sell your investment at that valuation and realize the return based on that. So my point here is, and this goes back to the fundamental topic, that we're discussing this morning. The only important valuation for the startup is the exit valuation. Actually, there's only two important valuations for a startup. The first is the valuation at which you invest, and the second is the exit valuation. That's it, because those two numbers determine 100% of your return in the investment that you made in that company. So all of the interim valuations, all the valuations in between those two are interesting and important in some ways, but they're not especially meaningful. Entrance valuation, exit valuation, only two important ones. And you see many cases of so-called unicorn startups that reach valuations over $1 billion and then exit at valuations way below $1 billion. And that's one of the worst cases for investors, because that means for founders and investors, because that means the returns, we don't know what the returns were, but they can be much lower than expected. So that's coming back to my example for 2C2P. You can read about this public information, but the 2C2P exit valuation was close to 600 million US dollars. So $600 million, yeah, it's not a unicorn, but so what? Actually, this is a tremendous valuation for any company, especially for high growth startup, and it generated fantastic return for us and all the other investors. And that's what's important. What's important is not does the startup reach a arbitrary $1 billion valuation, but does the startup reach a valuation that's sufficient to generate the required return for investors in that startup? And that also depends on what was the investment valuation. So we'll talk more about both of those points this morning. So how does VC investment process work? First we source for investments. We select and do due diligence on those investments. Then we do deal structuring and negotiation. Then we invest in the company. Then we help to accelerate it to scale. And then we manage a portfolio of companies that we invest in. So let's look at each of those points in a little more detail and talk about what do we need to do at each stage to generate successful exits. The first stage is the deal sourcing. In order to have successful venture capital performance, we have to source high quality proprietary deal flow. This is pretty much like any funnel. If you think about your VC portfolio as a funnel exercise, so the quality of VC portfolio is going to depend on the size of the funnel, meaning incoming investments into the fund, and then the average quality of those potential investments, and then the process that you use to select the highest potential investments out of that funnel. So you need to have as wide a funnel as possible at the top, with getting the largest number of high quality deal flow coming in. And then you need to have a effective process for selecting the highest potential companies out of that funnel. And I think one aspect that a lot of people miss about this is, I mentioned, we need sufficient quantity of high quality proprietary deal flow. And what does that mean? If you're a VC fund or if a VC fund is only seeing all the same deals as everybody else, then they're not going to end up with good deals on those companies. Because why? When we get to deal structuring and negotiation, we're going to see that one of the key terms that we need to negotiate is valuation. And if the VC fund is only able to get involved in negotiation with startups that everybody else is already interested in, then they're not going to be getting good deals on entrance valuations, which means that ultimately their returns are not going to be best case, the returns will be average for the market, and worst case below average. So we need high quality proprietary deal flow, large funnel, and ability to select the most promising deals out of that funnel. So generally, what type of companies do we look at? This is a graphic that illustrates the challenge that faces venture capital fund. Oh, by the way, when I'm talking about venture capital fund today, so I'm talking about early stage venture capital funds or very early stage venture capital funds like Expara. You probably know that there are many different types of venture capital funds focused on. We can cut different ways, focus on sector, but here I'm looking at focused on stage of investment. So some funds focus on a particular stage of investment. For example, Expara, we focus always on what I would call early stage or very early stage. And we have to be careful about these stage definitions because, this is another term in our industry that different participants treat differently. But we focus on what is real traditional early stage. So pre-seed, seed, post-seed, and pre-series A latest. This means very early in the life cycle of the startup. And so I will be, when I talk about VC do this or VCs do that, VCs think this or VCs think that, I'll be looking at that from the perspective of a very early stage VC investor. Now, a lot of these observations will apply to VC funds in general, but some may differ across stage. So what's a challenge that we face as a early stage VC? You look at this graphic and you see names of a lot of companies, and the question I usually ask, I think we're not doing interactive, question answers. I'll have to ask and answer myself. But so what is in what way are all these companies the same as each other, but different from other companies? And you usually get a lot of answers like, oh, they're all tech companies, but in fact, they're not. There's a few non-tech companies, and they're all one answer, they're all US companies, which is true, but how are they different from other US companies? So the point that I'm trying to get at with this slide is, if you look at the names of the companies on this slide, every one of these companies is or was at some point number one in their product category in their market, and not number two or three, number one. And since most of these companies are US, their market was either the US or global market. So that's why you see a lot of global companies here. But that's that's the first thing we need to think about as an early stage VC sourcing investment. Does the company that we're considering have the potential to be number one in their product category in their market? And everything else that we do flows from that. If the answer is no, then there's no point to invest in this company. And this highlights a very important distinction that I like to make early in any discussion about venture capital investment, which is why number one? I mean, and why is that so important? And this also highlights the difference, or highlights an important point that I think a lot of people also don't realize. The vast majority of good businesses and even great businesses are not good venture capital investment, because good venture capital investments, because of some structural issues that we'll hopefully touch on later, need to generate extremely high returns. The only type of investments that generate extremely high returns are companies that are going to achieve that number one spot in their product category in their market. So That's just the nature of this asset class. That doesn't mean that other companies are bad or wrong or shouldn't get investment, or shouldn't be, or entrepreneurs shouldn't be founding those companies. They definitely should. Like, let's say entrepreneur is founding a company that, could become number 5 or, 6 in a very profitable market. That's a great thing to do, and they should definitely do that. But they can't seek venture capital investment for that, because that company won't meet the profile for the returns required in venture capital investment. So the good thing, one, I think, good point about being a Southeast Asia startup, or a Southeast Asia VC, is we don't need to invest in companies that will only be number one in the global market. We can invest in we can invest in companies that will be number one in the product category in any market that is of sufficient size to generate required return. Now, that's an important caveat, because in most cases, for example, become number one in your product category, for example, in the Thai market, it's not going to be sufficient return. Uh, under In a few cases, it could be, but at the least, startup will have to become number one in their product category in multiple markets, if they're starting from Thailand or, for example, Singapore, uh, or they'll have to be number one in a product category in a regional market at least. But this is screen number one. Can this company become number one? And another way I like to look at it is, we're trying to build this graphic 10 years from now, because it takes at least 5 to 10 years to become, for a new company to become number one in a product category in a market. So if we wipe this graphic clean and then we start writing names on it, 5 years from now, we will see successful VC investments of today. Okay. But we don't look in every product category. So I mentioned number one in your product category in your market. There's really only 3 categories that the vast majority of venture capital investments are made in. Those are technology, so information technology, clean energy technology, and healthcare. And this has been true for the first 40 years, first 60 years of venture capital. And I think still true today and likely to be true in the foreseeable future. Not just because this is how venture capital has started, but because these sectors are the fastest growing sectors in the economy and have been for the last 50 years. So because high growth is such an important aspect of generating venture capital returns, we need to focus on high growth sectors. If you look at it, if you think about it this way, growing a typical startup to be a successful VC investment, a typical startup needs to grow in value at least 30 times over the first 5 years of its existence in order to generate required returns for investors, which is more than 100 to 150% a year growth. And it's it's hugely difficult to do that. And it's especially difficult to do that in a slow growing sector, or a sector that's not growing at all. If a sector is growing rapidly, this is like, wind in the sails for the growth of a startup. If a sector is growing slowly, this is like sailing into the wind for a startup that's trying to grow exponentially. The next screen that we look at is product or service driven business. Is the business mainly product driven or mainly service driven? If it's service driven, we don't invest. If it's product driven, we can consider to invest. This is because product scales, service doesn't scale. Service driven business means it grows basically grows by hiring more people. Service-driven business won't scale because people are not scalable, meaning the more people we hire, the more uh, our HR expense is going to go up. So in a business where we need to hire people to grow, uh, we'll never be able to scale as quickly as in a business where we can grow based on improving our technology. So my classic example of this is McDonald's, which employs about um, 1 million people worldwide and sells about 1 billion burgers a year. In order to sell 2 billion burgers a year, they need to employ another 1 million people versus Google, which delivers like 1 billion search results an hour, but can deliver 2 billion with just adding a couple of more servers to their data center. So people scale, people don't scale, technology scales. So we only invest in product-driven businesses. So it's not enough to invest in the company that's going to become number one in their product category in their market. The the product market needs to be tech, healthcare, or clean energy, and the business model needs to be product driven rather than service driven. So those are some very clear cuts that we're able to make to narrow down potential investments. But we have to also invest in this companies or these companies at the right time during market development. So we can't invest too early in market development, and we can't invest too late. And can you see my cursor or no?
Yeah, I can see
Yeah,
your
you see my
cursor.
cursor. So usually markets develop along this S curve. New product markets develop along an S curve where there's some period of slow growth. Market reaches an inflection point, grows exponentially, becomes saturated, levels off, and then is replaced by the next generation technology with a new S curve. So clearly, if we had a crystal ball and could see the future, and we knew that this was the inflection point, we would want to invest right here because we would miss the long, slow growth period, and then we would capture the exponential growth phase, which is, again, this is where another caveat or another screen I'm going to add on to the ones we talked about so far. So we need to invest not just in the company that's going to become number one in their product category in the market, but in the company that's going to become number one in that product category in that market during the usually first exponential growth phase of that market. So you can see how this universe of investable companies is getting smaller and smaller, right? We're putting one additional criteria on top of another until we are zooming in on companies that really have the potential to deliver required return. So one of the big mistakes I see a lot of founders and investors make is they're hyper focused on they want to invest at exactly the right time. There's meaning at the inflection point, but there's no way you're going to do that. It's impossible because nobody can time it and perfectly. So in real life, you're either going to invest before or after the inflection point. So I think key thing here is to focus on right before, as close as possible to the inflection point, but without missing it. So, because if you invest too early, the risk is that you're way too early and the market just doesn't start to scale before the company dies. And this happens a lot because this flat part of the curve can be very long. We don't know how long it's going to be. So we don't want to be too early, but we definitely don't want to be too late. If we're too late, then there's actually we have lost all opportunity to deliver required return. So, okay, so those are some of the big picture screens that we use to zoom in on which of the companies that are most likely to be successful, what kind of companies are most likely to be successful investments. Once we know what kind of companies, then we need to look at individual companies. So we need to be ruthless in screening now to individual companies to try to find the companies that out of this category have the greatest chance of success. And these are my 7 key elements for success, which are the factors that we want to look at in an individual company to see if it has the potential to deliver required return. The companies that reach this stage, now they should have already met all the criteria we're talking about. So they should be the potential number one in the right market with product driven, not service driven, and entering at the right time. So we already have screened down to sub universe of companies that meet those criteria. And now we're going to look at them on these 7 points to see, do they have now the qualities or characteristics that we find in companies that did successfully scale? Because if you think about it, the challenge of the company is going to become number one in its product category in its market 5 to 10 years from now. It's a hopeless criteria to apply because it's a prediction about the future and the far future, which nobody can do better than guessing, better than random at. So what do we need to do to arrive at a conclusion about that is we need to evaluate the companies on criteria that we can judge today, which are leading indicators of companies that could achieve that success in the future. So first we look at companies with innovative products and business models. Because why? Because most of the companies that are market leaders in new product categories during the exponential growth phase of the market are innovators. So innovation tends to be one of the unifying characteristics of successful market leaders during the first exponential growth phase of the market. We should focus, we should look not only at product and technology innovation, but also business model innovation, because we see many successful, scalable startups of the last 10 years built on business model innovation. Next, we want to look at the value proposition. So is the company solving a painful problem for customers? Because innovators who are not solving a painful problem for customers, we call solution seeking a problem. Solving painful problem for customers drives demand because people buy first products that solve painful problems that they have. And if a product doesn't solve a painful problem for customers, it's not a must-have, it's a nice-to-have. And therefore, especially for new company, demand is likely to be insufficient to enable the company to succeed. After we identify the company has the innovative product or business model that solves painful problem for customers, and in case you don't agree or don't really get the idea that pain drives demand, think about my favorite example. I think best example of this is the product that were driven to unprecedented levels of demand by COVID. Now, usually talking about 2020, 2021 COVID epidemic, but if you go back to 2019 and think about what was the demand for hand sanitizers and face masks and COVID vaccines was zero. And then 6 months later, they were the most demanded products in the world because pain of pandemic. And of course, that's an extreme case, but it's an example of all the other cases less extreme. Next thing we look at is the market size. So is the market size sufficient to enable the company to scale to a level that will deliver required return? Then the company's market entry and marketing strategy. How will they enter that market, which is of sufficient size? How will they dominate the market? And next, how will they get their product into hands of customers? And how will they sustain their competitive advantage? So the startup is innovative, solving a painful problem for customers. It gets early into a fast-growing market. They develop some advantage. Now, how do they sustain that advantage? Because if they can't do that, they won't, again, deliver required return. The most common mistake here, startup says that they're going to be able to do this because they have first mover advantage. There's no such thing as first mover advantage. Most first movers fail because they suffer from first mover disadvantage. We want companies that are going to be last movers, not first movers. The last mover is the company that will be the winner during the first exponential growth phase of the company. Not to say that first movers, so some first movers do become last movers. So not saying that first moving cannot provide advantage, but first moving itself does not provide advantage. First moving or early moving positions a company to benefit from last mover advantage, but it's not automatic. Next, we want to see what's the company's business model? How are they going to make money? What's their financial plan? How much money do they need to fund the business? What are they going to do with it? What type of financial results are they planning to generate with that money? How are they going to exit? And we'll talk about that later. And will they be able to deliver our required return? And then last, we want to look at the team. Is this a strong team or a weak team? A team is a strong team. B team is a weak team. A team will succeed no matter what. B team will screw up the best idea in the world. So when I summarize these points, which are the most important for me, the top three are team, team, and team, because entrepreneurs make successful companies. Successful companies don't build themselves. Products don't sell themselves. If we have the strong team, then we're willing to make some allowance on the other points. If we have a weak team, doesn't matter if all the other points are perfect, don't invest. So team, team, and team, just like your advice for real estate investment, location, location, location. Why are these two the same? Because location is the only thing about the property that can't be changed. Good location is good, bad location is bad, no matter what. Same thing for team, although we can theoretically change the team, but especially if you're an early stage investor, why would you ever want to invest in a company where you need to change the team? So what makes a good deal versus bad deal? Now, because we talk about now what makes a interesting investment. So now we have an idea what type of companies that we want to invest in. Now let's look at some of the deal structures. Now, this I think is important for both sides to look at because clearly the entrepreneurs should be concerned about the deal terms, but also investors should be concerned about deal terms that they're offering in the same way that startup founders should be concerned about deal terms that they are being offered. Because why? Obviously, if you're a startup being offered bad deal terms, you shouldn't take them. If you're an investor, and especially if you're a new investor, you should know what I would call on market and what are off market deal terms, because good investors offer good deal terms, and investors who don't offer good deal terms will not last in the market. So what are some of the key deal terms in venture capital investments, and what make those deal terms good or bad? Valuation. So valuation is how much is the company worth today? And in a bad deal, valuation will be too high or too low. A good deal is valuation reasonable. What does that mean? Reasonable for both investor and startup. So the tricky thing here is, or confusing thing here might be, some startups might think the higher the valuation, the better. And this is not true. Higher valuation is generally better than lower, but it's not a 45-degree angle, meaning the higher the valuation, the better it gets. Because there's a point, it's a curve, just like a lot of the phenomenon in our business. When valuation gets too high, this can be a bad thing for startup. And of course, valuation too low is a bad thing for startup and investor. Investors sometimes might think get the valuation as low as possible is good, it's also not good. So we want a good deal, which is reasonable valuation for both startup and investor. Investment amount, it's the same thing. Startups shouldn't raise too much and shouldn't raise too little. If they raise too much, they get over diluted. If they raise too little, they can run out of money. And same thing for investors. We shouldn't want to put too much or too little money into a startup. We should put the just enough amount, which is basically how much money the startup needs to get to either the next round funding or cash flow break even. Equity offered, same thing. If it's an equity investment, we don't want to go for too little equity or too much equity. So startups shouldn't give up too much equity in each deal, and they shouldn't also give up too little equity. And investors shouldn't take too much equity, but they also shouldn't invest in deals where they get too little. Average for most venture capital rounds is somewhere between 10 and 20%. Some are a little higher, some are a little lower, but that's a good benchmark. For liquidation preference, some of these terms might not be familiar. It's okay if not, just to give some quick overview. So liquidation preference, I prefer 1x non-participating liquidation preference. I think this is fair and most beneficial for both sides. Bad deal, no liquidation preference can also be okay, but the bad deal I see is more than 1x or participating. So I think participating liquidation preference is suboptimal both for startup and investor, unless it's a later stage investor and company is relatively highly valued. Founder vesting, no founder vesting is a bad idea. Good deal is standard founder vesting term. We use 4 years with 1 year cliff. Again, there can be some variation on that, but that's pretty much a standard, like what I would call on market founder vesting term. ESOP, which is employee stock ownership or option plan. Every startup should have one, but they shouldn't have one that's too big or too small. Average size 10 to 20%, depending on stage of development of the company and how many future hires they're going to need to allocate these options to. Anti-dilution. Anti-dilution has can be no anti-dilution, or broad-based weighted average is on market. Full ratchet is bad. And if investors are offering that, I would be very skeptical about why. I'm also really, I think we need to be really careful about intercept rights, like ROFO rights, and control terms. There'll be control terms in every VC investment, but we want to make sure that these are appropriate control terms, meaning that they don't overreach. So the biggest mistake that we see in VC control terms is overreaching, where VC is asking for way too much or way too granular control over actions that the board or the shareholders of the startup might take after the investment. Reasonable amount are going to be in every deal, every VC deal. The same thing on the intercept rights. I would try to avoid, if possible, rights that limit the company's ability to raise future funds or be acquired. So what are some what I would call deal red flags? So these are things that I would especially advise startups to look out for in deals that they're getting, especially if it's a new investor that you don't know. And if I'm an investor, I want to be really careful not to let any of these slip into my deal terms. So first one, question for startup: do they prefer smart money or dumb money investors? So there's two types of VC investors and venture investors. So venture investors are not just VCs, they're VCs, angel investors, corporate venture capital investors, strategic investors, sometimes government, etc. We can categorize within each of these buckets. We can find smart money and dumb money investors. To be clear, dumb money investors is not an insult I mean, it sounds insulting, but it's not meant to be insulting. It doesn't mean the investor is dumb. It just means that in our business, it means that they're not familiar with VC deal terms. So the deal terms are dumb, not the investor. A lot of what end up being dumb money investors are actually very smart people and even very smart investors, but they're just bringing their expertise from a different asset category where deal terms are very different. So startup founders need to think: do they want smart money investor or dumb money investor? I find some entrepreneurs think they want dumb money investor because they think they can exploit, the dumb money investors' lack of understanding about deal terms. It doesn't work like that. Entrepreneurs should always prefer smart money investors. The list of problems with dumb money investors, can spend the whole 1.5 hours discussing that. So I don't have time to go into that in detail today, but it's extremely long list. So smart money investor. If there are off-market deal parameters or non-standard deal terms, I would always this would always raise a lot of questions for me. Why? Why are there off-market deal parameters? Why are there non-standard deal terms? And again, if you're smart money investors, this links to question one, because smart money investors won't be putting in off-market deal terms or non-standard deal terms. Unless there's very good reason, you should never have non-standard or off-market deal terms. And then alignment of interest. We always want to make sure that every deal aligns interest properly between investor and startup. And this is one of the great things about venture capital investment versus many other forms of investment or many other forms of capital raising. There can be close to perfect alignment of interest between venture investor and startup, because they're both, assuming their both main interest is in selling the company for the highest possible return, then they will have perfectly aligned interest. There are ways that this can come out of alignment. So we want to make sure that if there are potential misalignment of interest in the deal, that we either understand why or get rid of those. And these are a few deal terms that I call runaway, because these are all deal terms that, in my experience, never work out well and almost always create terrible problems post investment. So I would try to avoid deals that include equity calculated based on or including non-financial contribution, unless it's something very straightforward like an accelerator program where all of the investments are structured like that. But in any other type of deal, including non-financial contribution or basing equity on non-financial contribution, it's almost impossible to do in a way that's going to satisfy both sides. I would never mix financial and commercial terms. So this comes up a lot during CVC deals, where CVC, corporate venture capital funds, have a legitimate and important interest in both commercial and financial terms, but these need to be separate in the investment deal. So if an investor and a startup are going to have both a commercial and financial arrangement, that's fine, but they need to be negotiated separately in separate agreements. We should never have a venture investment for a controlling stake. A venture investment for a controlling stake is acquisition. It's not investment anymore. And it's actually an acquisition where the entrepreneur did not get paid, because let's say somebody invests in your company and gets 51%. When somebody invests in a company, the company issues new shares. That's what investment is. So the money from that investment didn't go to existing shareholders. It went to the company treasury, and company issued new shares. But if the investor got 51%, now they control the company, which means they basically bought it, but they didn't pay any of the existing shareholders. So that's a acquisition for zero, and that's clearly not in the interest of the existing shareholders. Acquiring less than 100%. So this is where somebody does buy out existing shareholders, but they buy out less than 100% of existing shareholders. stake. This is acquisition at a discount. So whatever shares they didn't buy are never going to be sold unless this is an acquisition deal with a we call clear path to liquidity, meaning the share purchase agreement includes, sorry, purchase agreement includes specific provisions for acquiring the remaining shares, not maybe or sometime in the future. That's okay. But in a deal where there's a purchase of more than 50%, less than 100% without guaranteed path liquidity, this is just investment. This is just acquisition with a discount. There should never be uh, investors should never be requiring personal guarantees from founders. This is way off market term. We should avoid any deals where there's lack of trust or clear misalignment of interest. And more general advice, if there's any deal terms that sound too good to be true, or actually, I would say this is in any financial arrangement that you have in your life, whenever anything sounds too good to be true, it's not true. That's why it sounds too good to be true. So if something sounds too good to be true, you want to try to find out why it sounds like that, and in the end, you're going to find out it's not true. So why is exit strategy so important? That's our topic for the overall topic is about exit strategy. It comes down to how do we make money as a VC? We make money as a VC because we invest in companies, we acquire shares in those companies at one price, and later we sell those shares at a higher price. And the only way that we'll sell them at a maximum price is through a trade sale or IPO. Trade sale is when the company is acquired by another company. IPO is when the company goes to a public listing. In the absence of one of those two, we will never, what we call no exit equals no ROI, no return on investment. So that's why this presentation is called no exit equals no ROI. And I think this seems obvious, but I talked to, too many founders that don't seem to recognize this. Like, I asked the founder in the first meeting, what's the exit strategy? And they don't know or don't have one or don't want to exit. That means no ROI. And it's even worse than that because current valuation is actually determined by exit valuation. This is the fundamental valuation method that we use as VCs to value companies. It's called VC method. And what it does is it calculates the company's current valuation by starting with exit valuation and then discounting that by the investor's required return. So if you have no exit strategy, or if there's no exit strategy, this means there's no exit, no plan for exit. And if there's no plan for exit, there's no exit valuation. And if there's no exit valuation, there's no ROI. So how do we figure out exit valuation? It's actually, we do 5-year revenue forecast. This will give us the year 5 revenue. We multiply it by sector revenue multiple for acquisition, avoiding outliers, and we'll have an exit valuation. To make that a little easier to understand, put in numbers. Let's say if the company is projecting 100 million in revenue and they're going to exit in year 5 in a trade sale, and in this market, companies sell at 5 times revenue, then their exit valuation is 500 million, projected exit valuation. So that's why you can see why now it's important to have exit strategy. We need to know when we're going to exit. We need to have an idea what the revenue might be in that exit year. And then we need to know what are the revenue multiples that companies typically fetch in trade sale, which is one of our exit strategies. And now we can calculate exit valuation. So this shows you how current valuations are implied by exit valuations. You can see the higher the exit valuation is, the higher the current valuation is. Now, ROI is not just I said earlier that ROI is determined by only 2 numbers, which is current valuation, exit valuation. This is basically true, but it's a little simplified because we need to adjust for dilution. So after initial investment, here again, I'm looking at this from perspective of we're the first investor. So if we're the first investor, we're going to be diluted by subsequent rounds of investment. That's okay. Some investors think dilution is a bad thing. It's not. Dilution is a good thing because normal dilution means that the company is raising more money. If the company is raising more money, then that means if the company is raising more money and the valuation is going up, that means our shares are becoming more valuable and ultimately can get to a reasonable exit valuation. But it does mean we'll be diluted. In order to calculate our precise valuation based on exit valuation, we need to know what our dilution is what our expected dilution is. For early stage investor, I would expect dilution about 50% by the time we get to exit. So which exit strategy is best? This is just reviewing that our current valuation, ROI determined by exit valuation divided by current valuation adjusted for dilution, and exit valuation determined by exit strategy. So, these are some of the things that entrepreneurs have told me in first meetings when I ask what's the exit strategy. These are all wrong because a lot of them come from the right place. I don't think the founders really mean that they don't have any intention to exit. If they do mean that, then they shouldn't be raising venture capital. But it's really important for founders to think about the exit strategy prior to pitching VCs, because if they haven't formulated a reasonable exit strategy, first of all, their valuation is nonsense, and second of all, they're not telling the investor how they're going to deliver a return. Now, more sophisticated, but still, I think, insufficient exit strategy is trade sale or IPO, because trade sale or IPO are really the only two viable exit strategies. Now, this is a little confusing because in real life, our early stage exit strategy should be trade sale or IPO, but because we will do either one depending on circumstance. But I believe I think that we should have very strong preference initially for trade sale exits, because trade sale exits are hugely more likely than IPO exits. And the way I like to summarize this choice, I ask a founder, do you want to be rich and nobody knows who you are, or you want to be poor and famous? So poor and famous is your IPO. Rich and nobody knows who you are is your trade sale. I think all investors, they want to be rich and don't care if anybody knows who they are. So this is the myth, right? This is where successful startup, I need to have an IPO on NASDAQ. And again, this is one of these things where it's actually true. If you can get to successful IPO on NASDAQ, you should definitely do it. The other reality is you're not going to get to successful IPO on NASDAQ because there's only fewer than 100 companies that do that pretty much every year out of all the hundreds of thousands of companies in the world that are trying to do that every year. So it's like miracle to get to NASDAQ IPO. And IPO on regional exchange, you're going to make much less than trade sale exit. This is from the US market, which is the most active IPO market in the world by a lot. And here we see, even in the US market, in 2025 so far, in 2024 also, and pretty much every year, since 2015, 95% of VC exits are trade sale or buyout, and 5% or less are IPO. So this is of the very small percentage of startups that get to significant exits, which is somewhere between 12 and 3%, depending on what we consider significant. Only 5% of those are IPOs and on NASDAQ or New York Stock Exchange. So there's another way to think about it. There's maybe 100 IPOs a year. There's thousands of trade sales a year. So you're 10 times more likely to exit in a trade sale. Um, and this actually, I recently updated this slide. So this was 2020, halfway through 2024. Average valuation of trade sales by then was 220 million. In Q1 2025, it's over 400 million, 444 million. So close to half a billion average trade sale value for venture funded startup in the US market. Uh, Regional trade sale value can be lower, but nowhere near the difference of IPO versus trade sale. And you can see here how NASDAQ and New York Stock Exchange drive almost all the huge IPOs for venture funded companies. Uh, I you look at if you look at SET, MAI, you look at SGX. I mean, you look at any of the Southeast Asia regional exchange. I think MAI average valuation something like on exit for 2024 was something like 30 million US compared to 444 million for trade sale. I mean, the difference is ridiculous. Meaning what? If you're considering regional exchange, IPO, forget it. I mean, if you really think you can get to NASDAQ, New York Stock Exchange, okay, then give it a shot. But in real life, I think that's like a lottery ticket, but still difficult, but achievable exit. Close to half a billion in a trade sale, you can definitely have a much better shot. This is even, and if you look at most of the IPOs in Southeast Asia, they're not even tech companies or venture funding companies. Whereas M&A, still we see plenty of tech companies getting acquired. This is just what performance results look like for companies that list on regional versus major exchange. And summarizing, definitely trade sale is a much better exit route for both investors and founders. Because one thing a lot of founders don't think about, let's say I get to a successful IPO on a regional exchange, then when do I get paid? You don't get paid at the IPO because you get locked up by the exchange. And maybe you get paid later if you get to sell your shares in secondary market, but it's really hard to sell your shares in secondary market in any kind of volume without creating the share value. And liquidity on regional exchanges for mid cap or small cap companies, which your startup is likely to be, also is vanishingly small. Okay, so this is that brings me to the end of my my presentation.